All right, things together and use this in Excel. First, notice that we've copied all the information here, so it's in one place, and we're going to start doing the calculation below. Make sure we start with T0 because, as we saw, we're going to have some cash flow that occur at the beginning of the project. So, first item is that we're going to have the purchase of the asset. So, purchase the asset. And the amount we spend is 240,000, negative 240. We've used that throughout, but that's right there as the project cost. Next, we will say what is the sales trend for this company, and so the sales price is $200. Next, we say each year the sales price changes. So it changes by inflation rate. So it's last year's price times 1 plus the inflation rate. And we'll lock that because the rate is assumed to be constant here. So each year our price will go up by 3%. Unit sales was the same. It was $12.50 per year, and each year was that same number. So I'll just make that the same. And our total sales would be the sales price times the units sold. And copy that across. The cost per unit is also given to us as $100 for the beginning. And that is going to grow by inflation. So it's that first year would be 100 times open parens 1 plus the inflation rate, lock it, close parens, copy it across. Now we know our total cost, which is cost per unit times the unit sales. Copy that across. The depreciation expense we knew from before. I'll do these as negative numbers so that we can more simply add all the elements rather than have to jump around. So I'm going to make this a negative number. So depreciation is an expense, so we'll make it as a minus. And we're using makers, so we're going to go back up to the maker schedule that we determined earlier, which is right here. So year 1 depreciation was 79, and year 2 was 106, and the following year was 35, and finally the last year was 17. So now we have pre-tax profit equals, so you see why I put negative numbers, is the sales minus 125 minus depreciation. And so we have this is our pre-tax profit. Then we have a tax of 40%, and I'll state that as a negative 0.4 times the pre-tax. Copy that across. And now we end up with net income, which is the pre-tax minus taxes. Copy that across for the years. However, depreciation is a non-tax item, so we add back depreciation. And we get we could do a subtotal here, we'd like. And this would be cash flow from operations. So that is net income plus the depreciation. Next, we're going to take out the money that we have to spend to build our working capital. So we saw this just previously of 30,000 for the first, just as it starts off, and we have that going across, eventually getting back our money. Then we have gain or loss. Let's say we sell it at the end of the period. So the gain or loss in from the sale of assets after tax was 15,000. So the net cash flow is equal to, in year one, we had the purchase of the asset and we had to build some working capital. And then in the subsequent years, we simply had the cash flow from operations plus the, I'll just do a sum of the change in working capital and gain or loss in year four. So these are the net cash flows for the project.